Hey guys, welcome back to the YouTube channel. My name's Luke and this is...
Nevada here from Cube Home Loans.
There you go. And today we're going to be talking about boosting your borrowing power. So Nevada is my broker and he's an expert when it comes to understanding all things finance, working with banks, and all the tricks of the trade when it comes to getting yourself more money if you're looking to boost your serviceability. So we're going to talk about some different ways you can do that in today's video. He's going to give away some secrets.
Yep, hopefully some valuable stuff.
That's right. Some secrets that you may not know and that you can execute in your own journey. Or if you want to, you can reach out to the guys at Cube Home Loans. Their info's in the description below. So let's kick off. I mean, a lot of people are struggling with serviceability. It seems to be a hot topic at the moment.
It's certainly the ceiling factor in finance at the minute, just with the way rates are and property prices. And
there's probably talk that there'll be a rate cut and everyone will get that serviceability back. But in the near future, I don't think there will be a rate cut in the next month or two. So what are we doing at the moment? Let's kick off with, a classic lender's mortgage insurance. What would you recommend for most people, averages of averages, when it comes to using lender's mortgage insurance to further your investment journey?
Yeah, it's an interesting one. Obviously, if you have capacity to avoid it, generally it's better to. Not 100% of the time, but generally if you have capacity to avoid it, you should. Mm-hmm. In instances where you may have lender's mortgage insurance payable, limited cash components to acquire more property.
I've got 100 grand. Yeah. I don't want to spend all my money in Nevada. Like, let me spend 70 of it and get the loan that I want, but
absolutely
keep 30 grand buffer on the side.
Correct. And keeping cash obviously does reduce risk overall as well. So in instances where people have lender's mortgage insurance, in an instance where they need to utilize it, it's about minimizing what that premium is. A lot of people don't know this, but all lenders have different premiums, what they charge for lender's mortgage insurance, and the range is quite significant. So with the same deal, an example I've seen recently is one lender was $9,000, another lender was $17,000.
17K.
So it's a big enough difference that even if the lender with the lower premium had a slightly higher rate, that would make sense to utilize them most likely.
With LMI, a lot of people get excited that you can capitalize it into the loan. Yeah. So how does that work? Like, what does capitalizing in the loan mean?
So it essentially just means it's a fixed cost that's factored into the entire equation. I always like to give people the figure that's leaving their bank account. So we work out stamp duty. We even factor in, your conveyancing costs. We add a little bit of a buffer there just to make sure. And then I provide to my clients, okay, this is the figure that we're expecting to leave your bank account.
Yeah, this is the cash
there's no
out.
surprises. We don't go, this is your deposit, but plus stamp duty, plus lender's mortgage insurance, and just confuse people.
Here's all these other fees you need to factor in.
Yeah, you didn't know about that. And then all of a sudden you got to, people have, so we give the figure that's leaving that person's bank account.
Gotcha. And so in that data collection process, I'm a new client or I've got a few properties and I'm like, hey, Nevada, can you sort me out and get me some more lending? What do you need to actually work out what my current serviceability looks like?
Yeah, so it's actually quite a lot. So
sure is.
quite a lot of documentation, and we don't. We're big on collecting everything up front, and the reason is then when we're providing advice, it's accurate advice.
You got the full picture,
rather than there's a car loan that wasn't factored in, all of a sudden the picture's completely different.
Missing credit cards. And what kind of ways do you collect that? Do I have to send you a paper stack, or is it?
So we collect it digitally. A few reasons for that.
To know.
Yeah, one is obviously major one is convenience. Make it a bit easier for people, and then the second one is security.
Yeah,
that's a major risk at the moment, so we like to make sure our clients' data is safe. Collecting it that way is the best way. So all secure and portals and that sort of thing.
So I need to send you ID, pay slips.
If you're self-employed, financials, tax returns, rental statements if you have investment
estimated
properties.
Expenses.
Correct. And then the next component of that is a conversation where if I'm seeing any sort of gaps in the information provided or anything I want to get further clarity on, often throughout that conversation, I'm also uncovering maybe additional income we can use, options we have, whether if someone's open to closing a credit card. I have a client at the moment, they have nearly 20 credit cards active.
20 credit cards. What is if I've got a 10 grand credit card, just one, not 20. If I've got one 10 grand credit card, because I think mine's about 9K at the moment.
Yep.
What does that impact on my serviceability? And if I canned it, how much more serviceability would I generally get?
So what most lenders do is they expense it on the limit, not the balance. So if your limit's 10,000, they'll expense it at 3.8% per month.
Wow.
So that $10,000 credit card in their eyes is costing you $380 per month.
So it's hitting your serviceability at $380 a month, which could knock off 30, 40, 50 grand, depending on the lender.
Depending on the lender, quite significant. Same with car loans. So if you have a car loan repayment at $600 a month, that $600 a month is going off directly off what would be spare to go towards the new proposed loan.
Gotcha.
So huge.
So
impact.
get rid of all credit card. Well, not necessarily get rid of them, but have the chat with the broker.
Correct.
About whether I should close it, because I've closed credit cards in the past.
Yeah.
And that was a lot of people have that as a condition. You know, you've gone to buy a property and you don't need to can it yet, but maybe you need to can it if you want to get that full.
Correct. And another big one is actually student debt.
Yeah,
so
really.
The way student debt's calculated, the repayments are based on your level of income. So if someone has student loans but their income's really high,
they'll be paying a lot of student debt.
And the bank's factored in the same way. So in those instances...
as we know, student debt's probably getting quite expensive with the inflation numbers that they're recording.
Yeah.
So it's not just 1% interest.
Absolutely.
I hear it's like 5, 6.
Yeah, I've seen some big jumps.
Yeah.
In instances like that, I always recommend people reach out, have a chat first before they preemptively close something. And then we get, like you mentioned, approvals subject to this being closed.
Gotcha.
Just so we don't get an instance where someone preemptively closes something, that cash is gone. They're not going to give you the cash back.
Yeah.
And then we could have better utilized that elsewhere. So before you go and make changes, chat to your broker, get advice around it, and then get approval subject to, because you don't want to go and clear a student debt and then work out.
I want to keep my credit cards, man. I want to get those flight points.
Absolutely.
Don't make me close. So when I've got 20 credit cards, was this serviceability just hammered by?
It was having a big impact. A lot of them weren't even being actively utilized, so I was happy to close, I think 15 of the 20 or something.
They're just sitting there idle.
Correct.
Yeah.
His credit score was actually quite strong, which was a bit of a surprise when I saw that many cards.
Probably churning a lot. Yeah. Never missed a repayment.
Correct. Never missed it. And he was literally utilizing it points. He was sort of trying to
impressive. I think I've done 2 cards. I don't know if I could do... I can't be bothered to sign up these days.
It's a bit of a part-time job managing that many.
Yeah, it's enough effort getting enough points off one card. I don't want to sign up for a new one, do all the applications. But yeah, that's fair enough. Cancel those if it made sense.
Yeah, exactly. Okay. So there's some of the levers we can control, which can have a big impact on borrowing capacity. Some of the other ones are loan terms, so resetting loan terms.
So if I'm at 20 years on my current mortgage, we could go to 30, or I've even heard of more than that at the moment.
Yeah, some lenders, I think the top, some lenders go to 40 years.
Wow.
Those lenders generally have higher rates, so it's a plan B.
To extend that capacity.
Correct. So it's a plan B option and only if needed. Obviously, there's some considerations with resetting your loan term. If you're only then meeting the minimum repayments, you can...
a huge uptick in long-term interest.
Correct. So you want to factor it into your overall plan and make sure that makes sense. In saying that, I have a lot of clients that will reset loan terms, but then keep the higher repayments. They're obviously doing it at their own discretion.
Yes.
Paying a bit extra just so they're meeting that original loan term, just so they're not sort of, resetting things. They want to just clear it within that original period as well.
Gotcha. While we're on expenses, so we've kind of gone through mortgage insurance and then other expenses in terms of loans and personal loans and credit cards. With our everyday living expenses, what are some ways? I mean, a lot of people, we talk about rent vesting or moving back with mum and dad.
Yeah.
Are there ways that we can cut down our expenses for a period of time, maybe 6 months? How long do I need to have reduced expenses for the bank to seriously take it? Oh, you were spending 50K a year, now you're spending 40.
Yeah.
And that'll give you more borrowing capacity.
Yeah. So it's a little bit of a common sense approach here as well. So we look at people's living expenses for 6 months. We collate that data, then we get an average figure, and then we compare that with HEM, which is the minimum lender figure.
Yeah.
And then also compare that with what the person's declared.
Gotcha.
So in reality, some people actually spend below HEM. I have had clients.
I would have been well below HEM for the first 3 or 4 properties because Em and I were saving 50-60% of our income, if not more.
Exactly. The lenders are still going to work on that HEM figure regardless, unfortunately. Right. So in an instance where someone's a first home buyer, for example, they're saving and that sort of thing. Their expenses are likely going to be different when they're actually in the property and living in the property, for example.
Yes.
So we're trying to base it on the end result expenses, not necessarily the current expenses. It is good to limit discretionary spending. Like, you don't want to go too crazy.
So if I have been out to the pokies regularly, that'll hit my serviceability?
It will. It has to be factored in. So essentially gambling, just like any other recreational expense, will average it out. And then, and then if we can sort of see, okay, they've made a reduction, we can have a conversation around that.
So don't gamble, guys. Put your money into, if you're going to do it, put your money into the stock market or property, put your something in.
Yeah,
put your money
get some better odds.
Yeah, that's right. That's right. You're not going to lose it all, hopefully, in one go.
Correct.
Yeah.
A lot of people do get extremely nervous around it. The reality is everyone gets Uber Eats every now and then. So they're not.
Oh, don't look at my statements from the last week.
Don't be, too concerned about it. I've had instances where someone's had a once in a lifetime holiday within the last 6 months.
Gone to Europe, done the big Europe trip.
Correct. And they're obviously not doing that every single year. So obviously we factor that in and we sort of average it out.
Can lower that section of month because you can say, oh, they spent 15K, but they're not going to be spending 15K in the month of February every year.
Correct. So there's a little bit of common sense applied there as well.
Okay.
But generally we want to capture a good, accurate representation of what people are spending. And
are actually spending.
Yeah.
So I think that's a really good view on, you can only lower expenses so far. And so the other side of the serviceability equation is more money.
Correct.
More money equals, the ability to lend more money and then you're servicing more. So what are some ways if I'm working a day job, will banks look at second jobs? Will they look at overtime, commissions? How do those work when I'm earning?
Yeah, generally banks have all different policies on how they accept this additional income. There's a big difference, which is a bit of a silly one in my opinion, but there's a big difference between commission and bonuses, for example.
Oh, really?
So for whatever reason, commission's a little bit easier to utilize within the length of time you need to be receiving it.
Yep.
Whereas
and what counts as a commission? Is it quarterly or monthly or?
Yep, quarterly, monthly.
As long as it's got the consistency.
Correct. And if it says commission on there, on your pay slip.
Use the word commission, guys, if you're getting paid.
Versus a bonus, generally the length of time for it to be received is longer when receiving a bonus.
You might get once a year or sporadic.
The lender's view is a little bit more discretionary, where I have, some of my clients receive a bonus every week. And it's more of a performance-based bonus, which is very similar to commission. So it's kind of semantics in that way. But there's lengths of time that you need to be receiving. So overtime, for example, if you've been doing it consistently for 3 months, some lenders will start to annualize and utilize that overtime. So they can have a huge difference. I had a client who was a firefighter. More income in overtime than there was a base salary.
Yeah, they're probably on part-time as a firefighter, and if they're working regularly longer shifts, that would add up really fast.
Correct. Things like second jobs, some lenders will include. Again, they want to see a minimum period of time of you
working at the bottle O while
correct
after finishing,
just to make sure that sustainability is there so you can continue to do it. And some lenders have a hard cap on amount of hours in a week as well that they want to sort of utilize for income. So if someone is, having 3 full-time jobs, they're probably not going to factor, that number of hours because it's probably not sustainable long term. But that's different depending on different types of employment as well. I have had a fair few deals through where people have 2 full-time jobs.
Yeah, wow.
Because one is a bit more flexible and one is, a bit more
set,
needing to be there. Correct.
Interesting. I wouldn't want to work. Wow. I've probably done a few.
Self-employed, it's the same thing.
I was going to say, I've done a few full-time jobs, renovating, project management, running the business. But yeah, I think it's you've got to choose what's the right thing for you to boost your borrowing capacity. And the thing from my side, in building our personal portfolio and looking to grow is it's for a period of time. It doesn't have to be forever. Obviously, the banks are wanting to look at a long-term horizon.
Yeah.
But when they do your serviceability, it's at a point in time. It's where you stand in your jobs today. Obviously, the bank doesn't want you to quit the next day and go live in Bali and start running a business over there or doing something different. They want that confidence in where you're going. But to get that loan at that time, it's based on your serviceability at that point.
Correct. So we have conversations around, if I'm doing a loan for a couple and they're like, in 2 years, we might want to have children.
Kids is really common.
Yeah, we're undecided, but if we're thinking maybe 2-3 years, we might have kids. I'll generally do a serviceability calculator, including that dependent. It's not necessarily what we'll use with the lenders, but I'll just more to sort of highlight that for that particular, just to give them comfort around affordability. Yeah. There's one thing what the banks will lend you, but you also want to be comfortable with paying those repayments and sleeping comfortably and still being able to go to a cafe every now and then. And
you don't want to be worried if we go from 2 incomes to 1 income while we have above for 1 to 2 years. And then I might go back the wife might go back part-time or...
so make a bit of a plan around that just so they still have that comfort with their lifestyle as well. And
you've got to make sure that it's a long-term decision, whatever you're doing. And Emily and I have a bit of an advantage. I'm a chartered accountant by trade, so I run my numbers heavily before I'm going to my broker. And that's something else you can do to help your broker max that serviceability is show all the numbers. Don't just show a little bit. I like to show all of our income, all of our expenses, estimates, provide it all up front, because then you'll be able to get that big picture from the start. And then you'll be able to look at those alternate options.
And if you have out of the box unique circumstances, just raise them and make us aware of them, because there is lenders that are more flexible with accepting,
different
strange
types of income.
Yeah, even boarding income. If someone's renting a room in your house, like make us aware of these things, because it may help us out. We have a deal at the moment that originally the person was limited in their borrowing capacity, and they said, in a month I'm getting a $20,000 a year pay rise, and then we factored that in, works comfortably.
I've got a letter, it's going to come through.
So it's just easy enough to get a pre-approval on that basis. So as soon as he gets his first pay slip, ready to go. So.
I think a lot of people, there's talks of 1 to 2 income. So how big a difference does a second job? Because that person's, if you're one person, it is tough to get into the market. It's tough to save. You've then got hem on top. If I've got a brother or I've got a partner that I want to lend with, does it make a big difference if we're both earning 100K because hem's less when I add another person into the mix?
Correct. It does make it makes a massive difference. The hardest situation is a single applicant looking to acquire property
who's living in a penthouse in the city for $1,200 a week rent.
Correct. Even great income, everything can be perfect. Just the one income makes it very difficult for borrowing capacity. There's a lot more because of affordability. Even one of our brokers, Bart, he actually went in with his brother and purchased the property so they could buy in a more ideal location, and it's going to be a better long-term investment. There's a lot of that happening, even into like kids and parents buying together.
Gotcha.
Brother and sisters, friends. There's a lot of this happening at the minute because of that affordability.
And there was my concern with that was we've chatted about this before, so it'd be interesting to unpack it. Like I've always been worried if I didn't buy, say I bought with one of my sisters rather than with Emily, and then I wanted to go buy by myself or buy with Emily separately, I was always worried that my serviceability, I would have to cover 100% of that debt over there. And is that still the case in all circumstances?
Not all circumstances. So some lenders have a policy, it's called common debt reducer. So in certain circumstances, if there's a shared debt, they'll actually factor in your serviceability if you're doing a
your
project
50%
on the side,
if you're saying
they'll only factor in 50% of that debt, 50% of the income it may receive as well, which makes a huge difference because majority of lenders will factor in 50% of the income, 100% of the debt.
That's right.
Which has a massive impact on borrowing capacity. So that's called common debt reducer, that policy.
Yeah, okay. So just be wary of that if you are going down the investing route with a partner or someone, you are pretty tired. But you'll have some options potentially if you've bought with a brother or a sibling and you want to go buy with your partner now. There are banks and policies out there, which I didn't know if, 6 months ago, if you told me that, I would have just said, don't buy with anyone. Stop. But actually there's probably options there that you can explore. And that's part of chatting with the broker first and setting that game plan. I might want to buy with a sibling.
100%. And from an estate planning point of view, you certainly also want to chat to your accountant because there's a lot of moving parts around even, joint tenants in common, people buying under trust. There's obviously a lot of considerations on that side, but it's good to involve your full financial team in that process as well. So often I recommend people chat to their accountant on that side as well.
Great transition because we're going to talk about trusts.
Perfect.
So this has probably been the hottest topic. If you've been following my channel, I've talked about trusts before on the YouTube channel. Loads of guys in property talking about trusts and infinite borrowing power. Just give me a yes or no answer. Can I get infinite borrowing power if I buy in trust right now?
No, you can't.
Oh, come on. Mate, I want to buy another 50 houses and I want to buy Perth, Adelaide, Brisbane, Sydney, Melbourne. I just thought, I set up a trust, buying one, bank doesn't look at it anymore. How does this actually work? What is the secret sauce when it comes to trusts? But what's the catch as well if you're going to use trust structures?
Yeah. There's definitely some pros and cons, and there's a lot to consider outside of the lending side as well when it comes to tax and when you're selling the property, etc., outside my realm of expertise there.
Yeah, you got to worry. I can probably speak on that a bit more. You got to be worried about flow through of that asset. What happens to negative gearing? Is the property going to be negatively geared from the get go? You generally want to have cash flow coming through those trusts because if you don't, all those losses are going to get housed there. So there's lots to think on the actual P&L side of that investment.
And that can change depending on the type of property, like you mentioned as well, whether it's positively geared or negative.
Land tax can hit you too. Yeah, land tax will get a few people because Queensland has a threshold, but most of the other states don't for trust. You're starting from $1, when it comes to land tax, which can be $5,000, $10,000, $15,000 a year if you're buying an expensive property in terms of land value.
Correct. So some of the benefits of a trust is if the trust is set up in the correct way, certain lenders will allow you to exclude an income from that property and also exclude the loan that's within that property, as long as it's meeting certain criteria. It's covering its own costs, it's profitable.
So in terms of covering its own costs, this is where it gets very grey. I've seen people say, oh, if I send $1,000 a month to my trust, it's covering its costs, get an accountant's letter. And I've seen other circumstances where the property, you know, I have a house in a granny flat, it's renting for $1,100 a week.
Yeah.
It actually just covers it by itself.
Yeah.
Would banks look at both? But obviously you're living in the grey in terms of lending policy.
Yeah,
there.
I think the second criteria is the better one for sure. And it's more around, a lot of lenders will require an accountant's letter stating that this is profitable and able to meet its own commitments.
Okay.
So it's whether
your accountant needs to be comfortable with
whether
the
or
deal.
not your accountant supports it. And there's a lot of scenarios that can go on there, but if the reality is it's covering its own costs and there's a bit of complexity there, then your accountant's still probably be pretty comfortable with it if they understand it.
So make sure your accountant's probably set up your trust structure. So I bought a property recently using a trust, which we worked on together. That's the Bray Park Bomb, which is a suburb on the north side. That's what we're calling it. It needs a lot of work. We're probably going to do 150 to 200K reno on that place, add a granny flat. It's a fair bit of capital intensity up front. But then the beauty of buying that property in a trust is, one, I can look to refinance it. Maybe infinite borrowing power, maybe not. But I also get the benefits of having a trust with a potentially positively geared property. I can send the funds elsewhere.
Correct.
I have more lending options because it'll be positively geared. So my own situation, looking at trust structures, for me, it's got to be more income focused.
Yeah.
But it's up to you to decide, you know, if you're watching these videos and you're deciding for yourself whether a trust structure is right. It doesn't mean if you've got $100,000 that you can buy 10 properties. You're probably going to be able to buy one.
Yeah.
And then even in that case, if it's not positively geared, you're going to be struggling to get that letter from the accountant and then start looking at your next one in a trust structure.
And I generally see trust come into play when people have a few properties under their belt already. It's sort of a bit of when they start expanding their portfolio,
increasing complexity.
It comes into play a bit more.
Yeah. And I didn't buy in trust initially. We bought 3 houses in southeast Queensland in Brisbane, you know, a couple north and our own home south, and we just bought in personal names to start out with. Most people are going to be buying in personal names because of the simplicity.
Yeah.
The banks really understand that, and that probably leans into the last point, which is, you know, I'm buying my personal names, I'm tapping out. You know, can I look at different lenders? And is there going to be, I've heard of Liberty out there, I've heard of Pepper Money, or there's a lot of alternate lenders. How much further can I go from a mainstream lender at this point?
There's a huge difference between lenders. So whenever we do our servicing calculation, we get an indication of maximum borrowing capacity. And the difference between minimum and maximum can, you know, sometimes be $1 million.
Yeah. Same income, same expenses in the household, different banks.
The way banks generally work is banks obviously have different risk appetites and levels of risk they're comfortable taking on. Borrowing capacity is the limiting factor at the moment. Pretty much across the board, that's where people are getting stuck with lending.
I want to go from properties 2 to 3. Can you help me?
Correct.
Let me run the numbers and get back to you.
So this is where, in the recent months, policy changes have started to come into play because lenders are looking to obviously expand and attract new business. So they've made changes in this space to try to increase borrowing capacity with the right type of clients.
Yeah.
Some of those changes are including body corp and strata fees in standard living expenses. Some lenders are, rather than shading rental income, they're using majority or 100% of the rental income or 90% of the rental income, which can make a big difference if you have a larger portfolio.
1% refinances I've heard of. There's a few different lending options.
Reduced servicing buffers. So some people, some lenders, even for purchases, doing it at 2% rather than the 3%. And then there's the refinancing buffers at 1%. So a lot of newer policies there because the banks are aware that this is a limiting factor. They're still wanting to make sure people have affordability and there's that comfort and those buffers there. But there's sort of, some interesting policies coming into play.
Yeah, amazing. Well, if you want some help and you're wanting to maximize that serviceability, you can head over and have a chat with Nevada and the team at Cube Home Loans. This guy's my broker. I can recommend them from personal experience because we've refinanced almost all our portfolio at this point with the team there. So there's a description. If you go into the description, you'll see a link and Calendly or contact information that you can reach out to Nevada. The biggest thing for me is when you're working with a broker, it's about working with someone that can help you in the next steps. Running a property portfolio as a business, like you said, most people are getting stuck right now. So if you can find the right broker who can give you options, and at least you don't always have to use that serviceability. You don't have to always, say you've got $2 million capacity. It doesn't mean you have to go out there and spend it, but it's good to know what your options are. And it's good to know that I can boost my borrowing capacity if I have a chat with my broker and I look at my income, I look at my expenses, I look at maybe different structures to buy in to keep going in terms of that property journey.
We always say, I always try to encourage people to reach out early in the piece, even if they just have questions or they want to get some clarity on their circumstances. Like, it's a living and breathing strategy. It's not a transaction where we do it and then it's done. Like, I have a lot of people where we've done their serviceability, we've done their funding, and then as their situation changes, like they might give me a call up, a few months later, I've got a pay rise, and this is my overtime. I punch those changes in. Oh yeah, this is where your capacity is at now. And we just continue to work on that and develop that over time, particularly people with multiple properties. It's not just a sort of, a taxi ride where you jump on, get out, and that's it, never talk again. It's an ongoing strategy.
Every 6 to 12 months, touch base with the broker, see if you've got equity, see if you can tap into it, see what your lending options are.
Yeah, what are the bank vals at? We can organise that and see what the valuations are at, and then sort of just gauge on your options. You don't need to be 100% ready to go. Yeah. If you're just curious and want to have a chat, that's fine as well.
Awesome. Well, hopefully this has given you some insight into how to boost your own borrowing power. Thanks for sticking around. If you want to see another video with Nevada and I chatting, click it somewhere around here. All right, see you in the next one. Peace.
Thank you.